Hey everyone, it is Monday, and of course you know what that means. That means we start our expert series of the week, and we always start with Greg Dickerson. How you doing, sir?
Doing great, Michael. How are you?
I'm doing well. In this episode, we're both going to take out our crystal ball, excuse me, ball, and
Crystal AirPod case.
yeah, there you go, crystal AirPod case. Thank you for saving me. Um, and we're going to try to look in the future and just take what we're seeing now, and I'll describe that in a
Hmm.
minute. Our experience of the last 20 or 30 years and take a couple of shots at what tomorrow might look like. Does that sound like fun?
Yeah.
So let me paint a picture of what I'm doing now, and I'm just not sure where it's going to go. So my model for the last 2 years has been buy the junkiest house in the area, won't qualify, got to pay cash, takes usually 40 to 60% of purchase price in the repair. So it's a heavy lift. And then sell it, then stick a tenant in, and then sell it to a landlord, right? We did that 51 times in 20 months. What I had started to see this year is I was leaving money on the table. I had done a little 2-bedroom, 1-bath house, which in my model meant I had to sell it for 160 or less to get the return that my landlord buyers would expect. But in that market, I could have sold it to an owner occupant vacant for 180, right? So in this example, I'd already stuck the tenant in. I'm a good person, so I'm going to sell it to a landlord and move on. But the next deal I did, I'm going, okay, I've never sold to owner occupants. Let's try it. So I bought a 3-bedroom, 1-bath house, and I would have normally sold that for 180. I listed it for 199, not complete, right? Like, oh, by the way, coming soon, you know, these things still need to be done, but here are some early pictures for 199. And we had like, I don't know, 15 showings or something in 2 days. We had 6 or 7 offers, and we finally sold it for 201. Not done. And it's going to an FHA buyer. So I'm excited, right? We put an extra 21 grand in our pocket. We'll probably be about
Hmm.
19 grand because we got to do closing cost credits and stuff like that, but still 19 grand. But I look at that going, are we setting ourselves up for a real estate crash of bad debt from the FHA buyers, right? Because they come in with 3.5% down. You and I know it takes 6% of transaction costs to exit. So in a year, in 2 years, in 3 years, if we don't get this behind us, could we have a problem in the future? There's a lot there. I wanted to kind of paint the story I'm seeing because I'm perplexed, and I wanted to ask a guy like you, what does that feel like? Feel free to ask me any questions if I've missed something.
Yeah. So, that's interesting. And it's happening in a lot of areas. Obviously, there's a lot of retail buyers. Interest rates are at all-time lows. So house values are at all-time highs right now, pretty much everywhere. Now, there are pockets. I've got a young guy that I'm coaching in North Carolina outside of Greensboro. And, he did a house in a more rural type of location. It was still, subdivision-y populated, not like completely in the sticks,
Mm-hmm.
but bigger lots, 1 acre lots. And he didn't get that experience. It took him, market average days to get the property sold. It was probably 30, 45 days
Mm-hmm.
on the market, and he didn't have multiple offers.
Okay.
But some other areas of his town at certain price points were getting that same
Hmm.
scenario. Anything under 200, and that's a price point threshold. Anything
Yep.
under 200 in most markets like that are getting a lot of competition, getting multiple offers, and you're
Hmm.
seeing that FHA buyer come in that otherwise would not have been part of the equation a year, 2 years, 3 years ago. So the question is, are they going to be in trouble, and what happens when they realize that they're underwater? Okay, interest rates are at all-time lows
Mm-hmm.
in the mortgage industry. They're probably not going to get much lower. I think we're at the bottom. It's all based on the Fed's rate,
Sure.
interbank rates, and they're at zero. So the
Yeah.
so the mortgage rates really can't go any lower.
Right.
Okay, they can only go higher. We know what happens. As interest rates go down, house prices and values go up,
Mm-hmm.
just like a car. The reason a car is $70,000 to $100,000 now, or a truck, is because you can finance it for 72 months.
Mm.
It only used to be able to be financed for 48 months. Interest rates now, the lower the rate, lower the payment, the more house you can buy.
Mm-hmm.
Higher the rate, higher the payment, less house you can buy. So what's happening is these FHA buyers were renters. And
Yeah.
now it's cheaper to buy than it is to rent from a monthly payment, including taxes and insurance and maintenance. You're almost like
Yeah.
kind of breaking even there.
Certainly, if
They
you
can,
move urban to suburbs, certainly that.
exactly.
Yeah.
Yeah. Yeah, when you're talking about a $200,000 house, I mean, what is that mortgage payment after 3.5% down? 700 a month or
Yeah,
something?
seven, eight
Yeah,
hundred.
it's not much.
Nope.
700-800 bucks a month. So I mean, that's cheaper than rent in a lot of places. So
Yeah, for
that's what's
sure.
happening. And they're still looking at the borrower. They have to have a good job. They have to
Yeah,
qualify. So
for
the
sure.
underwriting standards compared to 2008 and 9
Oh,
are
much
very
stronger.
different, much more stringent.
Hmm.
It's the down payment requirement that's lower. So here's the big thing.
Okay.
What happened in 08 and 09 was the
Hmm.
banks were not friendly when the distress was happening and people were getting in trouble.
Absolutely.
And what was going on was the houses were uh, dropping in value significantly, but the interest rates were much higher. So people's payments were much higher.
Hmm. Hmm.
They were laying out a lot more cash. So they were looking at it from a strategic default standpoint and going, wait a minute, my house is worth half what I paid for it.
Yeah.
I'm paying exponentially twice as much as I can pay now to go rent or go buy another house somewhere else.
Yeah.
Let's just walk away. So what's going on now is if they're putting 3% down and they're locking in at a 2.75% interest rate for 30 years,
Hmm.
there is no downside. If the
Hmm.
house drops in value, by 50%, they got to live somewhere. So there's real
Hmm.
no downside because they're going to have a principal reduction as they go along.
Yeah.
So I'm not sure that's going to trigger strategic defaults like it did in the past. And what people's mindset is living in a house
Mm.
that's equivalent to rent where they're not building any equity through principal pay down at all.
Right.
I'm not sure that the value is a consideration in that equation at that price point.
Yeah. So I think you're right. Right. Again, I'm just playing with this because again, I'm in the market every day, and that's
Mm-hmm.
kind of the reason we do these channels and these interviews is we just talk, right, and we're always kind of trying to put the chessboard together so we can make decisions. So let's finish this, and then I have another topic for you in a minute that just
Okay.
came to me. So so in my mind, right, so again, I'm thinking about the buyer that's buying this 201K house. You're right. That's a 3-bedroom house. If he was going to rent it, it would probably be 1,250 to 1,400. So his
Mm-hmm.
payment is lower. When you add taxes, insurance, all of that, it might be break even. But you're right.
Yeah.
He and his family got to live somewhere. This one is going to be completely remodeled, roof to floor, including the garage. So he would be trading down. He or she would be trading down if they had to lose it. So that's very true. They got to live somewhere. Second, unlike last time, you're right. The banks are more stringent on the meaning saying yes to a loan, totally, but also they're more friendly on the paying, right? They're talking early, right? Forbearance and seconds and all this stuff. Very, very true. The other thing, unlike last time, is I believe that 30-year loan that this FHA buyer has in a year, 2, 3 years is actually going to be a valuable asset. And what do I mean by that? Let's just say they get in trouble in 3 years and they got to get out for whatever reason. I believe somebody can come in with a creative offer, right? Subject to existing financing, things of that nature,
Yeah.
and allow them to exit cleaner, probably without a real estate, saving on transaction costs, and negotiate some kind of time frame where they have to be refied out or something at a later date. But I think it's going to open up the opportunity for creative financing, unlike last
Mm-hmm.
time where prices were falling and interest rates were much higher. There was really no value in the mortgages last time because they were predominantly variable, right? They were 5 years.
Interest only, no doc loans, no
Yeah.
income verification, that kind of stuff. So it was a very different game.
Yeah, exactly. So do you think there will be value in a 30-year fixed rate mortgage at 2.75% in 3 years?
Yeah, absolutely. From that standpoint, the question is there going to be distress from that borrower to even
Correct.
trigger the need to, execute on a subject to or lease option or something like that? So yeah, just like commercial real estate, a lot of these loans that have prepayment penalties,
Mm-hmm.
if you lock in at a very low interest rate, now that's a very attractive assumable loan because in
Mm-hmm.
commercial, a lot of loans are assumable. In
Right.
residential, it used to be like VA loans are
Yeah.
assumable. Some FHA product is assumable. So yeah, especially if your loan is assumable and you
Yeah.
have a low interest rate like that, that's valuable.
Yeah. And again, I think that'll be different than last time because I think rates in 3 or 4 or 5 years are higher. And because again, I think as we've said many times, if you want to know when real estate slows down, you tell me when interest rates double, and I'll tell you when real estate slows down. Right? I mean,
Yeah,
that's
it's
the
all about
trend.
interest rates, and it used to be 5% was the threshold. Around 0405 was the peak of the market when when rates got close to 5%, it kind of started slowing down.
Mm-hmm.
That was our first hiccup in the real estate market back post boom,
Mm-hmm.
and boom was 2000s,
Mm-hmm.
2000 and 2004 or 5. That was the peak.
Mm.
Then we hit a little hiccup because of interest rates, and then it opened up. The throttle was open because Wall
Yeah.
Street created all those derivatives and
Yeah.
mortgage-backed securities and all that. So everybody had an appetite for those things, and then we were off to the races till 0809, and it was an unfriendly banking environment. They didn't care. They were foreclosing. There was no forbearance. There was no nothing.
Yeah.
Now anybody who wants to stay in the house, they're bending over backwards to make that happen.
Yeah.
So very different environment. The question is, can and when will interest rates rise? And I don't know when. Sure, they can, but can they really? Until we get through this situation we're in right now, the Fed can't really raise the rates, because anytime they try to raise rates, everything tanks. The markets, the real estate, everything.
Yeah, I'll put it out there just because I'm crazy that way. I don't think the 30-year mortgage sees a 4 on it for the most buyers, right? The rate that's quoted for at least a decade. It just can't. There's so
and
much
that's the new threshold.
Yeah.
It used to be 5, now it's 4. Everybody thinks 4 is a max number, and I mean that's just
crazy,
nuts.
right?
I mean, yeah. Anything under 10% used to be a good number when
I got a 7 and 8. Yeah, my first deal was 7 and 8. Oh my God, crazy,
but,
crazy.
It's like gas prices. People get conditioned, for $3 gas or whatever your threshold is in your area. When it gets over that point, their lifestyle changes.
Yeah.
So in terms of interest rates right now, anything in the 3s is good, but now in the 2s, I mean, every time it goes low, it conditions people to think and have a ceiling that they don't want to go beyond. So it's going to be really interesting to see, how, because rates don't have to change a whole lot to get back up into the mid 3s and close to 4.
Yeah.
The basis,
Oh,
so,
for sure. Yeah.
Yeah. But, the Fed has said, we want inflation. We're not going to raise rates. They want to try to spur inflation. And until you get demand back at the consumer level, you're not going to see any real inflation where it counts.
Yeah.
Asset inflation isn't real inflation. That doesn't count.
No, it doesn't count. Absolutely. And I think right now the Fed is far more worried about deflation than inflation. I mean, we'll hear what they have to say. Powell will speak Wednesday, the last Fed meeting before the election. So it'll be interesting what he has to say. So the other idea I had for you, and again, I've been playing with this in real time. I was looking for deals over the weekend. So this is in real time. And this is the riddle I'm playing with, right? Affordable housing in my area is a problem, right? There isn't any. And frankly, prices are going up. However, we have a part of town, just, call it whatever you want. There's a part of town that has older housing stock. Think 1950s. Every house is different, all on quarter-acre lots or thereabouts, 7,500 to 10,000 square feet. No real parking per se. It's a lot of street parking, just older neighborhood, right? I would guess right now that neighborhood is probably 60-40 renters versus owners. And it might even be 70-30, right?
Wow.
It's a part of town that landlords like myself, like I actually saw somebody sent me a report one time that said I am number 10 largest owner in that zip code. Right? They showed the spreadsheet. It was crazy. I was like, I didn't know that. But anyway, so lots of landlords are there. And I am wondering, and you can tell when you drive down the street, right? Like every fifth house has really green grass, and then the other 4 are clearly renters, right? It's just, there are signs that you can see, owner versus renter, right? I'm wondering, because they're smaller, right? They're usually 2 bedrooms. Some of them are 3s. There's even a few 1s in that area. It's just an older area. I am wondering, because you could pick up one of those houses today for like 125 to 160. It would probably take 30 to 40 grand to make them, modernize them. But, we could turn that into an owner occupant neighborhood pretty easily given FHA lending today. I'm wondering, what do you think about that idea? Because I think landlords, at least in California, are getting pretty stressed with all the regulation and all of that. What do you think about going to older neighborhoods and trying to solve, home ownership one house at a time, kind of in those focus areas? The problem I see is it's not new housing, right? It's not the 3-bedroom, 2-bath, 2-car garage, all of that. It's a 920 square foot, 2-bedroom, 1-bath, no garage. But again, the price point's lower. Like a 3.2 brand new in my area now is 400. You could probably sell these for 220. Does that make any sense to you?
Yeah, you're seeing that happen. So you're talking about from a buy, fix, and flip standpoint.
Yeah, and again, I'm really talking about focusing in on an area, right? You can always find deals outwards. I'm saying, hey, if you want to focus on affordable housing, let's go turn this neighborhood, which is 70-30 renters versus owners, into 80-20 the other way by upgrading, I don't know, 50% of the housing stock.
Yeah. Well, that takes an appetite on the part of the owners, the landlords to sell. So number one, you need inventory. So I don't even know
Sure.
what that looks like. Is there even any inventory in that area?
There's certainly some, but again, you could market to them. There's a lot of
Mm-hmm.
nonsense going on, right? You could go direct. You could also,
Yeah,
I think,
target the landlords.
yeah, exactly. And then again, one of the things you've seen with landlords is once somebody starts doing it in an area and profiting, they figure it out.
Mm-hmm.
Right? It'll pull. I don't know. This is the answer I'm seeing is home ownership is good. FHA buyers good. Affordable housing is the missing link, right? I don't
Mm-hmm.
think in my market an affordable house for the average person is 400 grand. So how can I find housing stock and create it for 250?
Mm-hmm.
That's probably not a new build, right? In my market anyway. So
Yeah,
that's what I'm trying to figure out.
Townhouses. I mean, there's some markets that they can build, at that price point, brand new, but mostly townhouses. But yeah, I mean that's a great solution. The question is, producing the inventory is the key there, and what is the real demand in that area when houses do come up for sale?
Yeah.
So people are going to want to live there.
Yeah. I'm actually going to check that. I talk to real estate brokers there all the time. I'm going to ask them about the zip code and figure out how fast stuff is selling.
Yeah. And then, from a business model standpoint, so if you're just doing it to create opportunity, that's great, but there's not a lot of money to be made a lot of times at that price point, relative to the risk that you have to take. So you have to determine, what are you willing to do and how do you make that model work? And then you could do the whole, a lot of times at that level, a lot of people won't qualify either, so it just really depends on your buyer pool, who wants to be there. What's the opportunity, from a business model, does it work? That's really the problem with affordable housing is you can't get the land at the right price. You can't build, with the costs that we see now for new construction. And a lot of it's the entitlement process, it's proffers, it's taxes, and it's the price point on the land. It's just you can almost, it's almost impossible to deliver lots in a subdivision for less than 30, 40 grand anywhere.
Yeah. California, it's more like 60 grand.
Yeah.
Yeah. It's pretty crazy. All right. So again, I'm just trying to play this out. Again, the beauty of having time is you get to play with interesting riddles, right? These are decisions I could have never thought about when I was a full-time employee. Now we get to, and I get to test it, right? I'm like, I'm going to buy that house. I'm going to try to sell it owner occupant. I've never done it before. Let's see what happens. Then I have the crazy idea. You know what? The market is so hot. Let's list it unfinished. Coming soon. God, we got, I don't know what it was, a lot of showings and we got a lot of offers. It was.
Yeah. That's the wholesale, that a lot of people try to create these buzzwords, silver bullets, calling wholesale, that's just a retail flip is all that is. You buy it, you don't do anything and you resell it.
Yeah. Oh, believe me, I'm doing something. Yeah. So it's just an interesting time. Again, I felt great selling the house, but it still raised that red flag. It's like, wow, he's coming in with 3.5% down. That's about $6 grand. Maybe it's $7 grand. That's top of market for that area. I'm a little concerned it won't appraise because I just bought it, 100 days ago for 105, right? So now I've already raised it to 201. So we'll see. But
if it doesn't appraise, they have to put more money down, or you have to evaluate what that's going to look like. And the good thing is that these buyers, they have to be qualified, so they have to have reserves. They've got to be able to pay the mortgage. But again, it's the same thing they're paying in rent. So at that price point, so it's an interesting thing. And the demand in different areas is very different and interesting as well. So that'd be a great business model. I mean, affordable housing is a big issue everywhere, and people think of it in terms of new construction. You just can't create it in new construction. So
that's
taking an older neighborhood and, gentrifying it like that. Well, it's not even really gentrification, just, turning it into more homeowner oriented versus renter, type orientation. I mean, that's a great model, but the key is going to be the supply.
Yeah, because again, you got to get land, because some of these landlords have owned them for decades. They probably have zero loans and they can probably carry them. Some of the housing stock in this zip code, because I've owned it there. I've owned some stuff there for almost 20 years. You can really tell that some of them are really slumlords, right? They've owned them forever. They're not updating them. It's just bad.
And
Others
then,
care. Yeah.
Yeah, some do, some don't. But then you have the issue where they obviously know what the house would retail for. So getting those houses is going to be the interesting thing, whether or not you can actually find a steady supply.
Yeah, I'm gonna play with that some more.
Yeah.
I'm gonna play with that some more. So let's talk about the other thing we'll kind of close out on is I'm telling people, and again, please disagree with me if you do. I'm basically telling people the rest of 2020 is going to be painful. We have more sins, more bankruptcies, just more yuck coming.
Hmm.
But like you and I talked about, I think it might have been 6 weeks ago, and I'm still holding on to this, that the entrepreneur is going to be a saving grace. I think the positive momentum starts to build early next year. And I think we're in a much, much better space by the end of next year than we are, today as we talk in September. Does that feel like the right thing to you, or do you see it entirely differently?
Yeah, I mean, I think it may take a little longer. So we talked
Okay.
about back when this all started, our conversations in March were 18 to 24 months for any kind of real recovery. That was
Yeah.
back in March.
Yep.
So 18 months puts you at the end of 2021.
Yeah.
24 puts you into 2022.
That's true.
And we are seeing the interesting thing that's happening now, and nobody knows, right? So we don't know. The medical professionals don't know. Nobody knows what's this fall and winter going to look like. But I can tell you
Yeah.
this, if we got a vaccine today, okay, to get the entire population that's willing to take it vaccinated, that's the end of next year at best. Even if you had it approved, done, ready, mass production today,
Mm-hmm.
most people aren't going to take it. So
Yeah.
you need that, you need the treatment, you need that
Yeah.
therapeutics, you need, the ventilator and the death taken off the table where people know if I get out and about and I get COVID, nothing's going to happen to me. I'm just going to be sick.
Yeah. It'd be
You
a
know,
miserable couple of weeks.
that's what needs to happen because I'm out and about and people still are not out in mass. I mean, I went to the movies again this weekend. Well, I've been to movies last 3 weekends in a row since they opened the movie theaters.
Yeah.
No more than 4 people in an entire movie theater. That's it.
Wow.
People still aren't going,
So
so.
why would a movie theater stay open? That they've got to be losing money. I mean, right? So like
Oh
a
yeah, yeah.
restaurant.
It's costing them. Yeah, it's costing them more to open than it is to stay closed. But I guess they feel like we got to give it a shot. We got to get back, and they may end up turning around and closing back up going into the fall and winter because that's what we don't know. All of the health professionals are saying we're at a high rate of infection going into the fall and winter. So what is that really going to look like?
Ugh.
That is going to weigh heavily on the minds of people and their behaviors. So, once we do get a vaccine out, we start vaccinating people and, treatments and all that. I mean, you're still looking at, this tsunami that hasn't rolled in yet. Okay. The tide is still going out. So that 18 to 24 months from the March timeframe to get back to any kind of real recovery in the retail, consumer-based economy where it counts. I'm not talking about Wall Street.
Yeah.
Wall Street's a whole differently disconnected, artificial thing that's happening that is not related to the real economy at all.
Mm-hmm.
It doesn't matter what anybody says. Look at the Fed's balance sheet. We talked about that, and somebody asked the question, how do I do that? Go to the Federal Reserve's website, and their balance sheet's right there. It shows you what they're buying, shows you what they're doing. Everything's right there. And as long as they're still buying these things, that tells you there's real trouble out there. Okay.
Yeah.
When the Fed stops buying and they stop printing money, then we're on the path to recovery. So watch what they do, not what everybody is saying. Because these guys that you see on CNBC and Bloomberg and all these channels telling you that, hey, the fundamentals are great and these valuations are cheap. Well, they're selling stuff and they're making money. You know what I mean?
Yeah.
They're trying to move markets with their comments and they're, it's not what's really happening on Main Street. So, it's going to take a while for that real recovery in the economy, which is what's keeping interest rates low, what's keeping the ability for people to buy houses and all that. The interesting thing with the housing market is, even in your area, in California with the fires, I mean, there's thousands of homes that have been destroyed. So now there's even less inventory on the market and there's going to be more demand for housing, rental and permanent, just from that alone. So there's continued pressure on that housing market, continued uncertainty with how do we get to the other side of this virus? We're going to have to learn to live with it. But what does that look like? And how does that affect people's behavior? That's the real thing. You have to watch what people are doing, whether they're getting back out and engaging in economic activity or not.
Yeah.
That's the real path to recovery. So I think at this point, maybe we're limping along by the end of next year back to about a, 70, 80% of where we were,
Okay.
now.
All right. Okay. So maybe an extra year, and that makes sense. Yeah, again, yeah, we've got more sins to pay for. There was just a gym I saw this morning in New York, I think, that just foreclosed, or not foreclosed, went to bankruptcy, but they're
Yeah.
staying open, right? Bankruptcy doesn't mean, liquidation, right? Usually means just restructuring debt, maybe some ownership, all of that stuff. So,
Yeah, repositioning assets, restructuring debt. And there's going to be more and more of that coming the longer this goes.
yeah.
And a lot of retailers are just waiting to get through the holidays, and then they're going to file in January, February, or
Yeah.
they're going to close, January, February. And, so we're seeing a lot of that in our area with shopping mall tenants, J.C. Penney's, Belk, companies like that, big ones, that are just limping along right now. So, that's just from the recovery. So to your point, yes, there's going to be a lot of opportunities for entrepreneurs in the real estate space and
Hmm.
in the business space, things like that, to step in and, reopen these things as the economy comes back. So that will create opportunity as we go along. The question is when,
Yeah.
when are you going to actually be able to take advantage of something and get reopened?
Yeah.
That's the real question, because it's all about that consumer demand and our behavior, as we go through this. And unfortunately, nobody has any new information.
Yeah.
Nobody really understands this virus.
Yeah. So what I take from the three topics we did today is single family homes, space is good, suburb living, FHA buyers are still the place to play today. Housing is the hot spot in the economy today, right? It is
Mm-hmm.
hey, look, everybody look, housing is doing really, really well. It typically is only 10% of GDP. It probably will punch above its weight class here shortly. Maybe it's 12, maybe it's 13, but it's not a huge mover. Um, but yeah, I think again, space is good. My area, again, right? A lot of the fire, not a lot, several of the fires are up by Fresno. You're right; they're losing thousands of homes, and they have to live somewhere, so they're going to
Yeah.
come to the proper city proper and be renters or owners. So interesting times. Any
Yeah.
closing
We are a
comments?
consumer based economy. So that's the thing that everybody needs to keep in mind. Forget Wall
Yes,
Street, forget what
yes.
they're doing and saying.
Watch the
We are
consumer.
a consumer driven, consumer based economy. So we have to get back to producing and consuming goods in order for real recovery to happen.
That's why I keep telling people I only watch two things. One is the consumer, and the other is cost of capital, because those
Yeah.
are the two variables for me. So, Greg, I want to appreciate your time today. Thank you very much. It's been a lot of fun.
Yeah, man.